Financial statements are the periodic report cards of how a business is doing from a monetary perspective. After all, money is the primary way in which the score is kept in the competitive arena of business. These important statements are a summary of the company's financial data compiled from business activity over a period of time. The four major financial statements used in business today are the balance sheet, the income statement, the owner's equity statement, and the cash flow statement. Together, they tell a story about how a company has performed in the past and is likely to perform in the near future. Financial analysis is the assessment of a company's past, present, and anticipated future financial condition based on the information found on financial statements. Financial ratios are the primary tool of this analysis. These ratios are a way of standardizing financial data so that they may be compared with ratios from previous operating periods of the same firm or from similar-sized firms in the same industry. The balance sheet is the financial statement that lists the company's financial position on a certain date, usually the end of the month, a quarter, or a year. To fully understand the balance sheet, we must first examine some basic accounting theory. Financial position refers to the economic resources owned by a company and the claims against those resources at a specific point in time. Equities is another term for claims. Keep in mind that a firm's economic resources must be equal to its equities. A business enterprise can therefore be pictured as an equation: economic resources equals equities. There are two types of equities: the rights of the creditors, those who are owed money by the business, and the rights of the owners. Let's take a look. The rights of the creditors are known as liabilities and represent debts of the business. The rights of the owners are known as owner's equity. Owner's equity represents the resources invested in the business by others. Theoretically, owner's equity is what would be left over after all the liabilities were paid to the creditors. We can now enhance our equation. Economic resources equals liabilities plus owner's equity. In accounting terminology, the economic resources owned by a business are known as the assets. Our equation now becomes assets equals liabilities plus owner's equity. This all-important equation is known as the accounting equation. The balance sheet is a visual presentation of this equation at a point in time. Some balance sheets display the assets on the left and the liabilities and owner's equity on the right. Another popular format lists the assets on the top and the liabilities and owner's equity below. Remember, on a balance sheet, the assets must be equal to the liabilities plus owner's equity. Let's begin by looking at an example here of a theoretical balance sheet and examining each section of its components more closely. A balance sheet for a corporation, Hypothetical Enterprises, Inc., follows. Carefully look over this statement. The following are the balance sheet components. First, assets. The assets section of a balance sheet is divided into three components: current assets, property, plant, and equipment, and investments and other assets. Liabilities and owner's equity. The liability and owner's equity section of the balance sheet lists the current and long-term liabilities incurred by the company, as well as the owner's net worth or claim against the assets of the business. This is known as owner's equity. From the accounting equation, it is the difference between the total assets and the total liabilities. Once the balance sheet has been prepared, a number of analytical procedures can be applied to the data to further evaluate a company's financial position. One common method of analysis of a single financial statement is known as vertical analysis. In vertical analysis, each item of the balance sheet is expressed as a percent of total assets, with total assets equaling 100%. Once the vertical analysis has been completed, the figure shows the relationship of each item on the balance sheet to total assets. For analysis purposes, these percents can be compared with previous statements of the same company, with competitors' figures, or published industry averages for similar-sized companies. A special form of the balance sheet, known as the common size balance sheet, is frequently used in financial analysis. Common size balance sheets list only the vertical analysis percentages, not the dollar figures. The following steps should be used to prepare a vertical analysis of a balance sheet. Step 1. Use the percentage formula rate equals portion divided by base to find the percentage of each item on the balance sheet. Use each item as the portion of the total assets as the base. Step 2. Round each answer to the nearest tenth of a percent. Note, a 0.1% differential may sometimes occur due to rounding. Step 3. List the percent of each balance sheet item in a column to the right of the monetary amount. Here's an example of a common-size balance sheet for hypothetical industries. Take a few minutes to review. Frequently, balance sheets are prepared with the data from the current year or operating period side by side with figures from one or more previous periods. This type of presentation is known as a comparative balance sheet because the data from different periods can be readily compared. The information provides managers, creditors, and investors with important data concerning the progress of a company over a period of time, financial trends that may be developing, and the likelihood of future success. Comparative balance sheets use horizontal analysis to measure the increases and decreases that have taken place in the financial data between two operating periods. In horizontal analysis, each item of the current period is compared in dollars and percent with the corresponding item from a previous period. Here's an example of a comparative balance sheet. When all is said and done, the question is how well did the business do? The real score is found on the income statement. An income statement, also known as an operating statement or profit and loss statement, is a summary of the operations of a business over a period of time, usually a month, a quarter, or a year. For any business to exist, it must have earnings as well as expenses in the form of either cash or credit. The income statement shows the revenue or earnings of the business from the sale of goods and services, the expenses, which are the costs incurred to generate that revenue, and the bottom line profit or loss, the difference between revenue and expenses. The income statement uses a simple profit or loss formula. Profit or loss equals revenue minus total expenses, where revenue equals earnings, either cash or credit, from sales during the period, and total expenses, which is the cost of goods sold plus operating expenses plus taxes. Once again, let's begin by looking at a typical income statement. As before, we will use Hypothetical Enterprises, Inc. to illustrate. Carefully look over the following statement. The following are income statement components. Revenue. The revenue section of the income statement represents the primary source of money, both cash and credit, flowing into the business from its customers for goods sold or services rendered. Cost of goods sold. The cost of goods sold section represents the cost to the business of the merchandise that was sold during the operating period. Gross margin. Gross margin, also known as gross profit, represents the difference between net sales and cost of goods sold. Total operating expenses. Total operating expenses are the sum of all expenses incurred by the business during the operating period except the cost of goods sold and taxes. Operating expenses differ from company to company. Some typical examples are salary and benefits, commissions, rent, utility, advertising, promotion, insurance, general and administrative expenses, depreciation, and miscellaneous expenses. Income before taxes. This figure represents the money of a company made before paying income tax. It's the difference between gross margin and total operating expenses. Income tax. This expense figure is the amount of income tax, both state and federal, that's paid by the business during the operating period. And finally, net income, net profit, or net loss. Literally, the bottom line of the income statement. It is the difference between income before taxes and the income tax paid. Vertical analysis can be applied to the income statement just as it was to the balance sheet. Each figure on the income statement is expressed as a percent of net sales equaling 100%. The resulting figures describe how net sales were distributed among the expenses and what percent was left as net profit. For analysis purposes, this information can be compared with figures from previous operating periods of the company, with competitors, or with published industry averages. As with balance sheets, income statements with vertical analysis can be displayed in the format known as common size, in which all figures in the statement appear as percentages. The following steps should be used to prepare a vertical analysis of an income statement. Step 1. Use the percentage formula, rate equals portion divided by base, to find the rate of each item on the income statement. Use each item as the portion and net sales as the base. Step 2. Round each answer to the nearest tenth of a percent. Note that a 0.1% differential may sometimes occur due to rounding. Step 3. List the percentage of each statement item in a column on the right of the monetary amount. Here's an example of a vertical analysis of an income statement. In addition to vertical and horizontal analysis of financial statements, managers, creditors, and investors also study comparisons among various components on the statements. These comparisons are expressed as ratios and are known as financial ratios. Basically, financial ratios represent an effort by analysts to standardize financial information, which in turn makes comparisons more meaningful. The foundational purpose of ratio analysis is to indicate areas requiring further investigation. Think of them as signals indicating the potential strength or weakness of a business. Frequently, financial ratios have to be examined more closely to discover their true meaning. A high ratio, for example, might indicate that the numerator figure is too high and the denominator figure is too low. Financial ratios fall into 4 major categories. Liquidity ratios that tell how well a company can pay off its short-term debts and meet unexpected needs for cash. Efficiency ratios, which indicate how effectively a company uses its resources to generate sales. Leverage ratios that show how to and what degree a company has financed its assets, and profitability ratios telling how much each dollar of sales, assets, and stockholders' investment resulted in bottom line profit. Business have enough cash on hand to pay their bills as they come due. The liquidity ratios examine the relationship between a firm's current assets and its maturing obligations. The amount of a firm's working capital and these ratios are good indicators of a firm's ability to pay its bills over the next few months. Short-term creditors pay particular attention to these figures. The term working capital refers to the difference between current assets and current liabilities at a point in time. Theoretically, it's the amount of money that would be left over if all current liabilities were paid by current assets. Working capital equals current assets minus current liabilities. Next liquidity ratio, current ratio. Current ratio or working capital ratio is the comparison of a firm's current assets to current liabilities. This ratio indicates the amount of current assets available to pay off $1 of current debt. The current ratio of 2 to 1 or greater is considered by banks and other lending institutions to be acceptable. Current ratio equals current assets divided by current liabilities. The acid test or quick ratio indicates a firm's ability to quickly liquidate assets to pay off current debt. This ratio recognizes that a firm's inventories are one of the least liquid current assets. Merchandise inventories and prepaid expenses are not part of quick assets because they're not readily convertible to cash. An acid test ratio of 1 to 1 or greater is considered acceptable. Quick assets equals cash plus marketable securities plus receivables, where the acid test ratio then equals quick assets divided by current liabilities. Moving on to efficiency ratios. These ratios provide the basis for determining how effectively the firm is using its resources to generate sales. A firm with $500,000 in assets producing $1 million in sales using its resources more efficiently than a firm producing the same sales with $2 million invested in assets. The average collection period indicates how quickly a firm's credit accounts are being collected and is a good measure of how effectively a firm is managing its accounts receivable. Note, when credit sales figures are not available, net sales may be used instead. Average collection period then equals accounts receivable times 365 divided by credit sales. Inventory turnover is the number of times during the operating period that the average inventory was sold. Average inventory equals beginning inventory plus ending inventory divided by 2. Therefore, inventory turnover will equal the cost of goods sold divided by average inventory. Asset turnover ratio tells the number of dollars in sales the firm generates for each dollar it's invested in assets. The ratio is an important measure of a company's efficiency in managing its assets. Asset turnover ratio equals net sales divided by total assets. When firms borrow money to finance assets, they're using financial leverage. Investors and creditors alike are particularly interested in leverage ratios because the greater the leverage a firm is used, the greater risk of default on interest and principal payments there is. Such situations could lead to a firm's eventual bankruptcy. Debt to assets ratio measures the degree that assets of the firm have been financed with borrowed funds or leveraged. This ratio identifies the claim on assets by the creditors and is commonly expressed as a percent. Debt to assets ratio equals total liabilities divided by total assets. Debt to equity ratio is used as a safety factor measure for potential creditors. The ratio compares the total debt of a firm with the owner's equity. It tells the amount of debt incurred by the company for each dollar of equity. It's commonly expressed as a percent. Debt to equity ratio equals total liabilities divided by owner's equity. Our fourth and final area of financial ratios, profitability ratios. The profitability ratios are important to anyone whose economic interests are tied to the long-range success of the firm. Investors expect a return on investment in the form of dividends and stock price appreciation. Without adequate profits, firms quickly fall out of favor with current and future investors. Gross profit margin is an assessment of how well the cost of goods sold category of expenses was controlled. In particular, this measure spotlights a firm's management of purchasing and pricing functions. Gross profit margin is expressed as a percent of net sales, where gross profit margin equals gross profit divided by net sales. The net profit margin is an assessment of overall ability to control cost of goods sold and the operating expenses of the firm. The ratio is the bottom line score of a firm's profitability and is one of the most important and frequently used ratios. Net profit margin can be calculated either before or after income tax. As with gross margin, it's expressed as a percent. Net profit margin equals net income divided by net sales. Return on investment is the amount of profit generated by the firm in relation to the amount invested by the owners. Abbreviated ROI, it's the ratio commonly expressed as a percent. Return on investment equals net income divided by owner's equity. In previous discussions, we used horizontal analysis to calculate and report the amount and the percent change in various balance sheet and income statement items from one operating period to another. When these percentage changes are tracked for a number of successive periods, it's known as trend analysis. Trend analysis introduces the element of time into financial analysis. Whereas data from one segment gives a firm's financial position at a given point in time, trend analysis provides a dynamic picture of the firm by showing its financial direction over a period of time. Index numbers are used in trend analysis to show the percentage change in various financial statement items. With indexed numbers, a base year is chosen and is equal to 100%. All other figures are measured as a percentage of the base year. Once again, we encounter the now familiar percentage formula, rate equals portion divided by base. The index number should be expressed as a percent rounded to the nearest tenth. Index number, your rate, equals your yearly amount, which is the portion, divided by base year amount, which is the base. For example, if a company had sales of $50,000 in the base year and $60,000 in the index year, the index number would be 1.2 or 120%. That's $60,000 divided by $50,000. The index number means that the sales for the index year were 1.2 times or 120% of the base year. To prepare a trend analysis, follow these steps. Step 1. Choose a base year and let it equal 100%. Step 2. Calculate the index number for each succeeding year. Index number equals yearly amount divided by base year amount. Step 3. Round the index number to the nearest tenth of a percent.